Welcome to this episode number 30 of your next trade called today Inflation Over. So first, I would like for you to stay until the end because I'm going to be making two announcements. Second thing is I would like to thank you because there are more and more viewers. And I can see that even some trading educators are trying to do exactly the same format as we have been doing for the last 6 months on a weekly basis. So thank you. And let's go now into the content. So the content, let's start with inflation. Is inflation really over? Let's start with this chart, which is some of the charts that we were using in 2021 and before, which is here, which is the US break-even 2 years, which is more or less telling us what are the expectations for market participants for the inflation over the next couple of years. And as you can see here, this is the 2% level, which is the target from the Fed, where the Fed is saying if inflation is above 2%, then we are in trouble. We know that they are playing a bit with this 2%, and the target is more or less since 2021 between 2 and 3%. But what is very clear is now market participants are expecting inflation to come down and probably go under in the near future under the target of the Fed, which is at 2%. So the Biden administration will say that actually inflation is down by 50% over the last 6 months. 50%, that makes the good headline number. We had this week a couple of numbers, the PPI and the CPI, and as well we had on Friday another inflation number. So inflation is still very high. I think going forward, market is very much driven, not as much as inflation as it used to be, but it's more about, looking about the growth going into H2. If we're going to have a soft landing, as the Fed is expecting and wishing for, if we're going to have soft landing or a hard landing, and obviously that's going to impact many other asset classes. So let's go into, as usual, the year-to-date asset performances, where the picture is more or less the same. So most of the asset classes have not been moving that much. If we could jump into the week-to-date asset performances, actually, the market for the stocks, looking at equities, has not been moving that much. We are talking both for the S&P, the Nasdaq. So the Nasdaq has been outperforming a bit the overall market and has been making a bit of a breakout. But very much what we have for most asset classes, it's a very dull market. What is clear for this week is actually FX. If you look at the US dollar, the US dollar has been strengthening versus most currencies between 1 to 2%. So there's a bit of a change. And in terms of risk on, risk off, this week has been very much experienced the weakening of the crypto, where we get the Bitcoin trading at 27,000. And as well, what is interesting, if you remember at the start of the year, it was all about China reopening, the growth being strong. WTI and copper are telling us a different picture. So what about the year-to-date industry performance? This is the same picture where semiconductor technology, actually home builders have been outperforming quite well. If you think about home builders, there were many tweets, many social media talks about, this is the end of home builders, and I've been doing pretty well. On the other end of the spectrum, we still got the regional banks and the banks and actually oil services and some others. So week-to-date industry performances, the silver, that is really the interesting picture. We have seen a sell-off on the silver. We're going to be looking at it in technical analysis. Same with the regional banks, the gold miners, the banks. So that have been the big losers for the week. On the other end of the spectrum, we got solar, cybersecurity, and cloud. Solar was really strong yesterday. Actually, I was caught in a short on one of the names that outperformed like hell. So a bit of a so-so day yesterday for me. But overall, what is interesting, if you look at the S&P, which is here, so that's roughly tells you the overall bad market breadth of the market, because if the S&P is roughly flat on the week and you get that many outperformers versus all these underperformers, that tells you that still the market is very much driven by a very, very few names. And we are talking the FANG of this world. We are talking, Facebook, Amazon, Apple, Google. Those names will be driven the market, and that explains as well what we get such a divergence between the winners and versus the losers, and as well why the Nasdaq is outperforming the overall market. So sectors performance now on the year to date, the picture is the same. Telco, consumer discretionary, IT pretty strong. S&P around 8%. Energy, the second derivative or the first derivative of the WTI oil is still struggling, and we get the same issue with the banks and the financials weak. So telco is very much the meta of this world, doing very well, but on the week, as you can see, energy weak, materials, industrials, same picture as before. What is interesting over the last month or so is the cyclicals have been underperforming the overall market, and very much what happens in those cases, it's a leading indicator of the recession might be coming. I know that there is a big debate, and I've been pretty clear of my view, which is going into H2 we will go into recession, but there is a lot of talks and a lot of barking, as I was saying last week, about bullish and bearish. What about the rates? The US 10 years is at 3.50, 3.47%, so more or less the same level as it was last week. As the equities have most asset classes, we are waiting for the next catalyst. And that is true not only for the US, but very true as well for Europe. Interestingly, the Japanese one has been, in terms of yields, coming down a bit. If you look at the 10 versus the 2, which is the yield curve, we are still around minus 50 bips, which is telling us that, a recession might be coming. What about the Fed funds rates? So we have been switching from the euro-dollar SOFR to the Fed funds rates for education, which is much easier. So Fed fund rates as of yesterday are at 5.08%. What do we have in the pipeline? If we look at the December 2023, for example, the market is expecting 4.49 from the Fed fund rate. So if you do 5.08 minus 4.49, that gives you roughly 60 bips or 0.6%. So the market is still expecting between now and the end of the year, December, roughly the Fed to cut rates by 60 bips. Most of the time that will happen that either when inflation comes down very drastically, and as well when there is a recession coming. So picture from the rates market is the same, Fed being very aggressive in cutting rates in H2. What about the VIX? What about volatility? So 17.5% as of yesterday, not that different from the week to date as of last Friday, but we had a bit of intraday moves with the PPI and the CPI on Wednesday, more specifically on Wednesday with the CPI. So we have a jump or a sell-off in the VIX, in the volatility. So CPI first move was sell-off of volatility. Volatility VIX went from 18% to 16%. In the meantime, stocks are going up. And then, when people start to go long volatility, then stocks start to go down. So, but overall, all those moves have been for the S&P in the same kind of range, which is close to the 4150. The vol structure is very much the same. What is interesting is if you look at the T-bills, the 30 days and the 60 days, we know that the debt ceiling is coming soon. Actually, probably the debt ceiling, the issue will be at the start of June, so that's roughly early June. And what is priced by the market is not that much of a crazy moves from the VIX futures. You could have, expect literally the VIX futures, at least for the June contract, to be much, much higher if that was the end of the world or a US default happening. And for the time being, the 30 days, the 60 days volatility is very much compressed. So volatility has been compressed. There are new products. We know that the 0 day to expiry are having a big effect, but that's an interesting play between the mismatch with the T-bills 1 month, 2 months, much higher versus the VIX in June, not pricing this phenomenon. So let's jump now into the technical analysis. So looking at the S&P Picture is the same. We are looking at the 4200. So here, this is the futures for the S&P, the 4200. We have been consolidating around the same level. This is a daily chart. What is very true is we are trading between the 4080 and the 4200 with the big magnet from the 4150 for many. Not only the gamma for options is between 4100 and 4150, but you do have a lot of positioning with options around the 4150. As long as we don't have a move, this is a wait and see situation where actually if you will be putting the same charts with the volume either for the futures, as you can see a bit, not that much here, but if you could do the same with a SPY, you'll see that the volumes have been very low, especially on Monday and Tuesday. So not that many participation in the market. If you look at the Nasdaq, there is a bit of a breakout here. So that has been the 13,300. We are a bit above now. Very much the reason being the big leaders, the big leaders or the big names, the big weightings of this index are making a moves, and here we could be jumping into that chart, which is looking at Meta, Amazon, all those names versus the S&P. As you can see, every single day almost we are trending higher. So if you are a trader, what you will be telling this market is more or less that someone has been putting a VWAP order where you start the week and you say, okay, you buy me those 5, 6, 7 names for the week versus the S&P, and every single day the algos will be buying it. It's very true that it's probably there are two reasons: the options and the passive investment. Why? Because passive need to be long those products, need to be not those products but those stocks. So the size of those stocks, I'm talking those 5 to 10 names, are getting bigger and bigger in the ETFs. Looking at the Russell is so much weighted towards regional banks that is not helpful. And as we've been looking before, the Russell versus the Nasdaq is the same picture. So Nasdaq is trading higher and Russell is at best flattish. But why? So here, looking at the regional banks, as I've been saying last week, there was a bit of what we call an island reversal, but I was clearly saying that the chances of being a good reversal trade were very low. You didn't have that many days. I think the regional banks, the issues are still the same. For the market to be panicking, I think that will have to spread to the big banks. And I'm actually not necessarily only following the KRE or this world, but I'm looking at names like Bank of America, JP Morgan, Wells Fargo. If you start to see some weaknesses in those names, you can make sure that first the market will start to panic a bit more, and as well that you're going to see more and more talks about the ban on sell. So really, this is the names. I will be more following those names, the Bank of America of this world, to see if there is more contagion and the market looking for more action. Emerging market / China, picture is the same, not necessarily a big uptrend. And here I would like to jump immediately into the CL1. So WTI doesn't look that much of a bull chart, and even more copper is not a bull chart. So those two commodities are not telling you that we are in a strong market. Coming back into some of the positioning that I'm having, which is the short Europe chart is at new high. So waiting for catalyst. If you are looking at technical analysis, doesn't look that much like this is a sell for the time being. So I might be completely wrong, but let's see how it goes. On with the silver, I don't mention that often, the usual suspects, which are gold and silver, because many of retail traders will be starting by the doom and gloom end of the world and be buying the silver and the gold. But more importantly, kind of a double top, triple top that we've seen in the past in silver and experience a big fall for the week, as more importantly on Thursday after the PPI where we experienced weakness. Euro dollar, so that was the chart that I've been showing where we had the from mid-March, a bit of a strong move, and over the last couple of days, Thursday and Friday, the dollar was really strong. So dollar was strong 1 to 2% versus most currencies. You can see the same picture here versus the dollar yen. What's going to be making the headlines tomorrow is we're going to have the Turkish elections. We know that Erdogan has been in place for more than 20 years, and the Turkish lira has been weakening and weakening and weakening. So there's going to be a lot of action probably at the start of the week. And finally, because we're going to have a lot of numbers going into retail, not only the retail sales, but some earnings for this week, like Walmart. Just look at names like Costco and some others, because that will tell you how the retail in the US have been doing. So this is it for technical analysis. So what happened this week? As always, I like to do a bit of S&P futures last 5 sessions. So here, this is the move that we had. So here, this is CPI, okay, and here this is PPI. So CPI, PPI, first move, always a tricky move for trading the CPI. Numbers for the S&P. Very often the first move is the bad one. So the first move was up. Why? Because volatility was smashed. The headline number, which was the 4.9%, was a bit below the 5% expected, but the core is still at 5.3%. So we're still coming back into the title of this episode. Inflation is still pretty high, but inflation is coming down. Here, this is a chart of the 10-year break-even that you can be finding on Fred if you don't have a Bloomberg. And very much the same picture. So here, this is the 2% level. We are just above the 2% level, but more or less inflation expectation for market participants are on the way down. It's still above the 2%, means the Fed will be saying, actually, we are vigilant, we need to be careful, we are data dependent, and blah, 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 and blah, blah, but it is coming down. So inflation, CPI coming down high, but coming down. What about the consumer confidence? So we got Michigan yesterday, not that good, and I think it is important going forward into H2 when we do know that the cash reserves from most Americans are dying around, I think it's October, looking at the numbers. So H2 will be a struggle. 441.50 for the target. So this is the target, which is here. A market has been driven around those options strikes for quite a long time now. Now I'm interested into Europe and versus US, and I've been saying that I've been short Europe for the last couple of months. The reason is very much, I think the expectations are too high. The market is very much driven by the hoo-ha-ha luxury is great, the LVMH of this world. But if you look at the economic surprises that are here, so Citigroup is doing some economic surprises. If you get access to a Bloomberg, if you get access to Reuters, you can have those data. So here you can see in yellow how has been the trend, and we can see that from the start of February, the yellow line has been coming down. So Europe is starting to see some cracks in terms of macro expectations, macro numbers that will be coming, and I think the overall region, which is making 15 to 17% of the world GDP, will start to underperform. If you look at China here, which is in gray, pretty much the picture is we know that from mid-March onwards, the market has been, the economy has been peaking in China. So we had the hoo-ha phase, which started at the start of the year, which is here. The hoo-ha phase, where it's the reopening of the economy, and it's very much clear that when an economy is reopening after COVID, you have a base effect. Yesterday, I listened to one analyst meeting, which was CFO in Switzerland, which is doing luxury, and what they were saying is actually they are still expecting in the long run Asia to be very strong, but we should not expect the same kind of recovery and reopening as for the Europe and for US, for example. So Europe, China, that is for the picture. So what about the catalyst for this week? So starting, we got the retail sales. I think this is very important On Tuesday, we get the US retail sales plus the industrial production. And on top of those retail sales, we get Home Depot here on Monday and Walmart, which will be on Thursday. So that gonna gives us hopefully a better picture of how the retail in the US have been doing and what are the expectations going forward. And we do have as well many Fed speakers. So that will be that column starting with Bosti Kashkari on Monday. But more importantly, the big one, the boss, Fed Powell, will be talking on Friday. And in between, what we have is we get the OPEX, options expiry for stocks on Friday, and the VIX expiry on Wednesday. And we know that market is very much driven by those options that we are all waiting for this something to be happening and the market to move. So far, not happening. So maybe something is going to be happening. So sorry for that. I didn't check today actually what was the expectation. I'm pretty sure that the expectations are not that very different, but as always, check your SPY straddle on a daily, on a weekly basis. And finally, as I said, the debt ceiling is coming. So debt ceiling, the issues will be coming. In terms of data, I put a bit more data, macro data, because I'm kind of missing, and lacking real drivers, real catalysts. So first thing first, the core retail sales, as I said, which are on Tuesday. What we can see is we had a very good January, which was on the base effect and some taxes. But so far, since then, we have a slowdown in retail sales. Expectations are for plus 0.2%. 0.2% month on month versus the last one, which was down 0.3%. So that's going to be very important. Finally, something that I usually not be looking that much, which is on Thursday, which is the initial jobless claims. So there has been an article on Bloomberg saying first that the numbers, there was some frauds that actually were putting the numbers higher than what they should be. But more importantly, if you look at the cycle and the recession coming, very often what you're going to have is initial jobless claims will tell you between 300 days to 500 days when they are bottoming that a recession is coming. So if you look at 2000, if you look at before, this is the case. As we can see in this chart, is we bottomed recently at 180, roughly that was the number, but here I'm talking the 4 weeks average, and now we are going higher. So again, another signal that recession might be coming. Finally, as I said at the start of this call, some announcement to make. So on Thursday, the 26th, if you're not on Discord, please join us. I'm going to be doing a Ask Me Anything question on Discord. So that will be on Thursday, the 26th, 1 hour before the close. So that will be 8 p.m. UK. That will be 3 p.m. New York time. Then I'm going to be doing a webinar, which are the 10 trading lies keeping you away from making money. Why I want to do that? Because both as a trader and as an educator, I could see that many of you are coming and losing money. And actually what is interesting is not only retail, but the professional is losing. So that will be a free webinar. That will be again Thursday the 1st. Join us. That could be interesting. And finally, as always, join us on the trading community. If you get questions, you can send me an email. And if you get questions on the 4x4 video series and or the mentoring, please feel free. So this is it for me for the week. A lot of retail sales. I forgot to mention that as well. There is a lot of housing number coming for next week, where the home builders have been very strong. And at the end of the week, we get two big drivers, which are the option expiry and Fed Powell talking. This is it more for me for the week. I'll see you next week. Bye-bye.